After investing $12.50 per week into dividend-paying stocks, our classroom portfolio has an annual return of 23.65% and has grown to $1,925.64 after 116 weeks. Hi, Professor Rex here. We are now a little over 2 years into our class project where we invest $12.50 weekly into 10 different dividend-paying stocks. The portfolio continued to grow quickly this week, boosting the annual return, as I mentioned, to 23.65%. And, as I mentioned in an earlier video, don't get too excited. It's highly unlikely we can sustain a return that high. Otherwise, we'll all be quite rich very quickly. So if you're new to my channel, I teach college accounting, and I often show my students how to use accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting a little over 2 years ago, each Monday I invest actual real-world money, which is $12.50 per week, which is roughly the equivalent of $50 a month, into 10 dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week or to the list of our best performers or any other section of the video. So in 2022, the year we started the portfolio, the market did not perform well. But because I don't believe in trying to time the market, we just kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $1,925. And the return has been 23.65%, which is higher than the S&P 500. Last year, the portfolio's return was 28.6%, which also beat the S&P 500. And in the preceding year, the portfolio once again beat the market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower, 4.27%. The study is updated each year and was recently updated to include last year. So go check out the source link that I include at the bottom of the screen. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying stocks are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks, as measured by beta and standard deviation, tend to be much lower for dividend-paying stocks than non-dividend-paying stocks. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. So why did we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? Next slide talks about that. So the main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents per week for a total of $12.09 per week instead of $11.74. For our classroom stock portfolio, in year 2, we boosted the weekly investment 82 cents to a total of $13.32 per week. And in year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. A very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio is 1925.64. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's value would only be 1641.83, a difference of 17.3%. And some YouTube viewers were wondering how our portfolio has done versus SCHD, which is why I included this slide. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach, where no one is overseeing the stock selection of this ETF. SCHD has at times had large positions in stocks I consider to be value traps, and I want to avoid those stocks. This slide shows our best performing stocks based on when they were initially purchased. Stocks in yellow have been sold. So the best ones are Lam Research and Broadcom leading the pack. Also remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column in the middle. Specifically, the category called Dividend-Growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies. But studies have shown that they historically beat the market averages by a significant amount. This slide shows our best performing stocks this week, ranging from nearly 18% to 5%. Our portfolio, as you can see, had a lot of good gainers this week. The best performers were Worthington Steel, an under-the-radar dividend payer, and WK Kellogg, a cereal company. So if you're eating Frosted Flakes out there, thank you for supporting our stock portfolio. Now let's talk about the 10 dividend-paying stocks we bought this week. Here's our ratings for the top 12 dividend-paying stocks this week. We purchased the 10 stocks that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of our portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And with Fidelity, you can buy stocks with as little as $1. In other words, you could buy Amazon stock and invest only $1 in it. Obviously, you would get just a partial share, also called a fractional share. This table includes the stock's industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates that they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of the purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies show that they historically beat the market averages by a significant amount. But this week, all the stocks we bought are high quality and are dividend growth stocks. We did not purchase any under-the-radar dividend payers this week. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags of the company's accounting practices, as well as the quality or reliability of the reported earnings. Earnings are also called profits. And finally, the last quality component is financial health. Remember historically the best performing stocks are those that pay both a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Devon Energy, Skyworks, one of our best performers, Dollar General, and Bank of New York Mellon. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth. But that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are American Express, MasterCard, Apple, Comcast, and Visa. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast, MasterCard, and a Visa. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation, something that bonds cannot do. On this slide, we are looking at stocks in our portfolio that have raised their dividends recently. 13 of our stocks raised their dividend by over 10%. Including a 50% increase by Carrot Packaging. Here's a look at the 10 stocks that make up the largest portion of the portfolio as of Sunday. Remember, we want to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky and more diversified portfolio. It's true that the portfolio's returns would likely be higher if we always invested in our top 10 stocks regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated and more volatile portfolio. And many investors cannot psychologically stick with a volatile portfolio. That's something that new investors have trouble understanding. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are now at 90. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies make it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. So those are the companies that we bought this week. We're trying other strategies too, using real stock portfolios. Besides this dividend growth strategy, we're also running the following portfolios: a high yield dividend paying stock portfolio, Another portfolio with stocks with the best competitive advantages, also called moats. Note that all stocks eligible for that portfolio, both dividend-paying stocks and non-dividend-paying stocks. And finally, we started a technology-focused portfolio investing in these themes: artificial intelligence, big data, cloud computing, cybersecurity, software as a service. And the next slide has more details about this technology portfolio. And because my students are enamored with tech stocks, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it in only tech stocks. Unlike our other portfolios, we are not investing additional funds each week. We are sticking with the original $1,000 investment. As I mentioned, the tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. So far, the portfolio has increased 18.2% in less than 3 months. The S&P 500 increased 10% over the same time, but since this is a tech-only portfolio, a better comparison was with a technology ETF, such as VGT or XLK. The largest tech fund or tech ETF is Vanguard Information Technology, VGT, and it's up 9.2% over the same time. Best performers so far are NVIDIA, Pure Storage, Meta Platforms, formerly called Facebook, CrowdStrike Holdings, and SAP. So in the comments, let me know if you have any questions or if you want to know more about the other portfolios. Also, let me know what other kind of investing videos you would like to see. It's spring break here, so I have a little bit more time to do stuff. And finally, here are the places you can reach me. YouTube, obviously, as well as Twitter, also called X, LinkedIn, and my website, beatthestockmarket.com. Have a great week.